This is the Chapter 11 video overview. Chapter 11 focuses on investing basics and investing in bonds. Start with establishing investment goals using a form at the end of Chapter 11. A CFP is a certified financial planner that can help you review your goals periodically. Essential steps before considering an investment program is that you must have an emergency fund and you must be contributing to an IRA. Using the chart below, consider the 5 factors that should be evaluated. Safety and risk go hand in hand. You can have one or the other. Same with income and growth. Liquidity should be evaluated for all. An investment pyramid will help you determine the type of risk that you are willing to take. Most younger couples prefer staying in level 1 and 2. A rule of thumb: 110 minus your age equals the percent in growth investments. For Jamie, Lee, and Ross, 110 minus 38 equals 72%. 72% is a bit high for their risk profile. Carol's recommendation, who is their financial advisor, says that they should do 50% in high-quality growth stocks and growth-oriented mutual funds, and 50% in long-term government bonds and high-quality U.S. corporate bonds and stocks. Investing in bonds. Bonds are called fixed income securities. Investors buy for their safety and stable income stream. Fixed income rate is usually paid for the life of the bond. 2 basic categories of bonds: government and corporate. U.S. Treasuries don't pay a lot, but they are almost risk-free. Corporate bonds are the firm's debt and are riskier since they have a risk for default. Municipal bonds are almost as safe as U.S. securities and have the advantage of being tax-free in the state of issue. Fixed income securities are coupon rate usually fixed at the issue. Long-term assets 20 to 30 years. Government securities, treasuries, bonds, notes, and T-bills. Municipals, general obligation, and revenue bonds. Corporate bonds, bond ratings, higher rating, lower interest rate, lower ratings, higher default risk. So you can see that you will have lots of choices in investing in bonds, but your primary concern should be whether you are willing or able to take a risk, and that will determine what kind of bond you may want to consider. You should have an emergency fund, and you should be adding to it ever so often. A rule of thumb for emergency funds is that you should have at least 3 times your monthly expenses, and more in difficult economic times. For Jamie, Lee, and Ross, your monthly expenses equals $4,264, so if you multiply that by 3, their emergency fund should be $12,792. They currently have an emergency fund of $21,000, so they're doing quite well. Where will the money to invest come from? This is where your short-term goals will come into play. Pay off all your credit cards first. Set up a separate account to save for a new car. For Jamie Lee, this is the example in the book. Allocate $5,000 per year to add to your investment portfolio, and they had triplets, so will this be enough to insure the triplets college fund? End of this video.